Hello and welcome to our new series of web chats on hedging. Today we have Helen Kane, CEO and founder of Hedge Trackers, one of the leading consultants and advisory groups on hedging and all the implications. And we're going to be talking about the potential opportunities and pitfalls of constant currency reporting. Helen, welcome. Good to see you.
Thank you. Thanks for having me.
This is a complex problem. Can we start with a mind map to understand what we're really talking about?
That would be great. I did want to highlight to you that where this whole concept and idea had come up. I was working on a project for a client, frankly, to understand what their competitors were doing related to currency risk management and hedging. And I ended up looking at a number of 10Ks and 10Qs and was quite surprised to find that a word search on the word currency was returning hundreds and hundreds of hits. Unfortunately, only about 3 per 10K or Q had to do with hedging, but the rest were talking about constant currency results. And by the way, those results weren't even correlated to constant currency impacts in any way, which led me to this mind map or picture concept that we've got where, you know, if you'd go to next, I thought that we should start this discussion of constant currency and hedging with a dive into what constant currency is. In this graph at the left, we're showing kind of our expectation that when a business grows and thrives, we expect to see that clearly and linearly represented in the financials. And when a company is struggling, we expect to see that, you know, just as clearly. But what happens is on the right-hand side, when we add currency into the financial reporting mix, all of a sudden a downturn might be masked or exacerbated by currency moves. And growth similarly might be leveraged or neutralizes as the currencies change.
And that's really quite a complex problem. How are companies, let's have a look at how companies are describing their currency positions.
Basically, I've pulled a number of examples for the group to look at how people are talking about constant currencies. In the first two, and let's just start with the first one, we use the results on a foreign currency neutral basis as one measure to evaluate our performance. What they're telling us is that management is evaluating its own performance on a constant currency basis. In fact, in the next one, we manage our global businesses on a constant currency basis, and we manage market risk from currency exchange rates at the corporate level. In this second quote, they're basically claiming that internal performance, kind of as well as this external reporting, is evaluated purely on a constant currency basis, and that market risk, frankly, is a C-level responsibility. So we really have people talking about their business and business results. Very clearly, management is focused on this constant currency approach. In the next 3 quotes that I have, I want you to listen kind of to the precision that management is claiming to understand their constant currency metrics. So especially this first one, the pro forma core margin was up 460 basis points in total, with 200 points coming from currency and 260 points from operational improvements. The next one, all market share, now we're talking market share references, represent the percentage of sales in dollar terms on a constant currency basis of our products relative to all product sales. In the next one, we're talking the total company sales increased 6.3% in 2018 and 17.1% in 2017, excluding the impact of foreign exchange. And then the final one, we increased sales by 2% in constant currencies, but improved net income by 12% in constant currencies. I thought it would be useful if we took a quick look at the basic math that presumably is driving this constant currency reporting.
Because they are very different statements, aren't they? They're representing very different views of currency and management.
Well, and it's showing that management is very focused on this constant currency concept and presumably using it to run the business internally.
Okay, so let's move to the next slide where we're going to understand why you need constant currency reporting.
Okay, so the AICPA has even published kind of an article that recommended how constant currency reporting should work. And basically, it's giving companies the ability to compare their financials period over period with a number of currencies in, frankly, in an attempt to get back to that, that linear relationship that when business is good, the results look good, and when business is bad, I guess they never want the results to look bad, but getting us back to that relationship. So here I've tried to put together a very kind of simple example where a company had 1 billion euro in sales in 2017 and 1.1 billion sales in 2018. And because the weighted average revenue was recorded in both years at the different weighted average rates, we're going to see that they're both going to deliver 1.23 billion in US dollar revenue. So here you can see we've got, 2017 at a rate of 1.23 and 2018 at a rate of 1.12. So the devaluation of the euro by 10% is totally offset by the 10% increase in euro sales. So if we look and do a comparison of the 2019 sales at the 2018 rate, we can see that on constant currency basis, our sales have actually gone from 1.23 billion to 1.35 billion and are able to report a 10% constant currency increase. Now, this makes constant currency reporting look pretty straightforward, but as usual, things are not as straightforward as you would think.
And so what are you concerned about here?
Well, let me give you an example here of where the math gets a little bit more complex and the results are a little bit different than you might expect. Let's take a look at a manufacturing example where the US dollar cost of goods sold is $16 in both years and remains constant year to year, as does the euro sales price of 100 euro. So both values are going to remain constant, the $16 cost and the 100 euro revenue. First, we need to get our costs onto our euro books. And so you'll see there that in euro terms, it's going to be much cheaper this period to actually purchase the US dollar cost of goods sold. And then we're going to translate these values into US dollars for consolidation purposes. So on the left, we have the 2018 as they would be reported, and then on the right, the 2019. And there you see kind of the $11 change in revenue attributable to the currency movements. So intuitively, we would expect to see when we do constant currency that there would be zero change in revenue and frankly, zero change in our constant currency margins. But I want you to watch what happens when we do our constant currency magic math.
Magic maths, I like that.
Okay, so here in the middle, you'll see I have constant currency reporting. On the right-hand side, then I'm going to get what is the effect of my constant currency, and then what will I be reporting to the world as the impact. So on the revenue line, things come across pretty much as we expected. There's an $11 change that I'm reporting, and I'm going to say the constant currency effect of that change was $11. So I have a zero increase in revenues on a constant currency basis. But then in margin, I'm saying on a constant currency basis, I had a 1.6 or $1.06 change, but I had nothing that I was reporting as a change. So on a constant currency basis, I'm actually going to be showing that my costs have been reduced by 10%. And then net effect is my margins have improved 2%. So
that's a problem, isn't it? Because you're actually confusing the investors.
yes, I think that you could say that this might be a bit misleading, which is the biggest concern, and frankly, the SEC's concern when it comes to constant currency reporting.
Okay, so do we need to go to the next slide to look at the concerns here?
Yes. So what I found in reading the description of the calculations that people were using for constant currency was about almost as many approaches to constant currency as there were registrants, at least just as many definitions of how they were doing it. Here were a couple that stood out to me, and I'll share with you why. In this first quote, you can see that they say we calculate constant currency net sales and operating income by applying the prior year average exchange rates to current financial data expressed in local currencies in order to estimate an elimination of the impact of foreign exchange rate movement. In this second one, they're talking about changes in exchange rates, and then they say with both the previous year and current year indicators calculated using the same exchange rates. And then they go on to specify the exchange rate used is a projected annual rate determined by the company for the current year and applied to both previous and current year. So in both of these, things are getting more confusing because not only are we talking about constant currency math, but now we're using exchange rates that we aren't even using in our financial statements.
Okay, that's a serious problem. How do we look at it?
Well, I wanted to kind of show one way that just using rates could actually muddy the waters even further than just the simple constant currency math. If you go to the next slide, we'll see that I'm showing kind of an example where a company generates their revenues pretty consistently through the year. And so using a simple average like that first company had talked about might be an appropriate way to calculate a constant currency change. You can see on the far right that the simple average and the weighted average of their sales, because those sales were consistent through the period, we get to the same rate. But if we look at this second example, there's a company that's revenue is highly concentrated in the fourth quarter. So we're actually using a simple average. If we were using a simple average to calculate the revenue, it would be grossly misleading. But then again, if I used this 1.19 rate to also communicate, changes on the expense side, that would be misleading. So I'm very concerned that gross simplifications, not using the rates that people are actually using in their financials, and kind of in that last example of quotes where people are just making up rates to apply, is really giving us constant currency results that are inappropriate.
But is this treatment quite common?
Unfortunately, I think that it is very likely that the external reporting group, or FP&A, might be using operational expedients like, the simple average of last year's rates that they look up on the internet to provide these misleading results. And I think it's, our role in treasury is people who understand not only what's going on with rates, but how they're used in the financial statements to perhaps get involved and participate, especially if we're going to be looking to hedging them in the future.
And the other feature of this is that the authorities in different ways are looking at this.
Yes. On the next slide, we're kind of looking at some of the SEC's concerns. They have taken a deep interest in all non-GAAP reporting. In fact, I think it was the pressure from the SEC on the non-GAAP reporting related to hedges that drove the FASB to simplify hedge accounting in the US. And the SEC has been highlighting this Reg G in presentations that it's doing on non-GAAP reporting, especially related to constant currency. And they're demanding transparency around the calculations of cross-currency, which is where I'm picking up these quotes, is that the companies are required to, frankly, to disclose the math that they're using. However, their greatest concern, and after looking into this and doing some research, their greatest concern and mine is that we're generating misleading results.
Okay, so what do we do about it?
I think that what we have to do is really find the most appropriate way to calculate constant currency results. Really, if they're going to be used as the metric of foreign currency that we're going to be using. You can see, though, that that's not going to be easy to do, especially when we get multiple currencies and multiple currency results involved. I think companies are going to need to be thoughtful to ensure that they're using appropriate and relevant rates. And those might be different rates for revenues and costs and operating expenses.
Who tells them it's relevant?
Well, right now, no one is telling them that they're relevant or irrelevant. They are really should be constrained by the Reg G that requires them not to present non-GAAP reporting measures that are misleading. And so really kind of figuring out those relevant rates is a responsibility of cross-currency reporting. And the reason that we're going to care on our side on Treasury is that if we want to hedge and protect what is clearly management's, deepest understanding of currency and currency risk in their financials, we need to understand what the rates are, how they're being used, so that we can deliver a hedge program that can protect year-over-year changes.
The issue for me is, how do they use the right language that is meaningful to the authorities, but also to the investors, and is not misleading? Because that's a combination that's really quite difficult.
Yes, and I think that what's going to be important is actually figuring out what are the appropriate calculations so that the results are meaningful on an ongoing and consistent basis, and the appropriate math behind that. Since we're going to be reporting on that math irrespective, I think it's of the utmost importance that we're thoughtful about the math used in constant currency, especially if we're going to turn around and start talking about hedging that difference.
Okay, so if you bring all this together, what are the key takeaways, which are obviously listed here, but why are these the three key takeaways?
Okay, first of all, what became apparent to me is that constant currency is a key concept for senior management. They're reporting that they're using it to measure themselves internally. They're using it to explain their results externally. If it's important to them, and if it's important to our key stakeholders, then I think in Treasury, we need to stop and take a look and figure out if constant currency should be important to us, not only how it's reported, but recognize that as what our management sees as currency risk. The second point is, I think that, again, in Treasury, we need to get a handle on the calculation methodology that is being used and ensure that the results that we are reporting are not misleading. We've already started the constant currency journey because we felt that without constant currency reporting that our results were misleading. But have we moved kind of the misleading due to currency rates to misleading due to poor math? So I'm very concerned that people are using methodologies that are and may be misleading. And then the third thing is I want us to think about, going back to the first key takeaway, that this is important to senior management. I'm wondering how many of them in Treasury are thinking about the objectives of our hedge program. If senior management is focused on the impact of constant currency reporting, then I think we should take a step back and evaluate if constant currency impact is something that our hedge program should be addressing. And that really kind of tees us up for the conversation for our next webcast, which is on hedging the constant currency impacts.
Okay, so this is clearly important and clearly at different levels, both in Treasury, but at the C room and so on. This new web chat that you're going to do, the second one, is to how to align constant currency reporting and your hedge program. What are you going to be covering there? How are you going to make that real for treasurers?
Well, I'm starting out with the assumption that many of us are operating hedge programs that really exist in isolation. Our management doesn't understand and frequently doesn't value what the hedge program is delivering. And I thought, how powerful would it be to show them that their hedge program was mitigating the only currency risk that they measured, understood, and were communicating to their stakeholders. So my thought was to take some of the time and energy that I've put into figuring out how would you mitigate for more than 1 year this year-over-year constant currency risk. And that's the ideas that I want to share with you and your audience on our next webinar.
Well, thank you very much. Very interesting.